All right, so goal of our webinar today, as is stated clearly in the title, is to walk through some of the core pillars involved in IPO readiness. I will call out right at the start, this is a complicated topic. We have 45 minutes together, and so really the focus is to cover some of the core pillars and then ideally get a layer deeper from the experience of Chris and Parker on our call today. We'll also say that this is an open forum. So if you have questions, if you have tips that are related to any of the points, feel free to post in the Q&A, in the chat, once we get that working. Any of your suggestions, obviously, the more interactive this can be, the better for everyone involved. And so would highly encourage folks to pop in. It's quick setting the stage. I have our chart of IPOs over the past couple of years. Notably, what we'll see is that there have not been a ton recently.
Ouch.
And so really what we're ideally hoping is that this is the year that begins to change that. I think a lot of the people on the call are ideally hoping there's one on the horizon. It also makes it really hard to predict when readiness becomes hypercritical, and it's also something that, as we'll spend a lot of time talking about, can't be done on a dime. Very much needs some thoughtful planning ahead. So with that, I will turn over to our voices on the call today. We're joined by Chris and Parker. Chris, do you want to kick us off with a quick intro on your side?
Yeah, hi, I'm the head of strategy for Numeric, and my background is an auditor. I spent the first 20 plus years of my career working for Ernst & Young. I loved my time there, and I'm really excited about looking at the problems that we are trying to solve here at Numeric with the auditor's lens, and just working cross-functionally with all of our teams, engineers, sales, operations, and I'm learning so much. So really glad to be here and share my experience with you all.
All right, Parker.
Hey everyone, I'm Parker, one of the co-founders here at Numeric. I have not taken a company public, so I am very excited as well to learn from Chris and to participate where I can be helpful. But thank you all for joining. It's a real pleasure to get to do this.
Alrighty, so with that, walking through our general roadmap for today, we're first going to spend the bulk of time talking about some of the foundational pillars to take a company public. Chris will touch on some of the lessons that he's learned working with companies on their roadmap for IPO readiness. We'll then dive into some of the common pitfalls, general strategies for success, and then round out with a Q&A, any open questions that folks may have. So with that, beginning with those foundational pillars. So what we'll touch on today, first, we're going to start with stakeholder engagement. A lot of the insights that have come in conversations ahead of this with Chris is that while IPO readiness is part of the accounting team's role, it's not just the accounting team that is largely a part of this process. And so how can you essentially incorporate thoughtful engagement with other stakeholders who should be in that room? And how do you ensure success with everyone that's partnering on the IPO process? Turn over to Parker to talk about faster close processes, with the idea being if you can compress that close timeline, it's a core pillar of IPO readiness. Financial reporting readiness, table stakes. Many of y'all already probably got your eye on that, and so cover a couple of quick tips there. Controls and SOX, also pretty critical. And then we'll round it out with understanding of how do you get your systems in place and upgrades. So to get us started on our first core pillar, Chris, would love for you to walk through some of the key people in the IPO room and how teams should think about engaging them correctly, properly, and any tips and tricks here.
Yeah, for sure. I think, you look at these pillars, I think even folks who haven't been through an IPO can surmise that these are some of the key players, but a successful IPO really requires execution across a lot of dimensions and functions. Probably too many to list in pillars here. I think the whole organization is tied up in it. It's truly the culmination of the work of a myriad of internal and external stakeholders throughout a number of ongoing and integrated work streams. So, key pillars and players in the IPO process, traditionally involving investment bankers, external auditors, legal counsel, company personnel. In terms of company personnel, while the CEO and other executives may play an important role in marketing and the public messaging, given our audience, I think, and the expanded role of the functions of the CFO organization that are relevant to IPO execution, wanted to highlight that here. So not to say that the other orgs within aren't critical, but the sub-functions within the CFO org play a huge role in the planning and execution. So thinking about controllership and FP&A, those are the sort of meat and potatoes, and they play a heavy part in getting the numbers right. But there's a lot of other key areas within the traditional CFO organization that make contributions during the process. I'm thinking about tax team, right? Scaling as the company grows its international footprint, which can happen leading up to an IPO or after. Looking at NOL limitations and other key tax disclosures in the S1 and ensuring compliance with public company requirements, especially the realizability of DTAs and presentation of DTLs. Those things require careful documentation, and there have been plenty of examples where companies have gotten caught up and had to go fix their financial statements for those presentation issues. Those can derail you during the process and also after, as we've seen. So tax team, very important. From an IT and security perspective, I think you're involved early to scale financial systems for SEC reporting and tech infrastructure. They're also a linchpin in data security compliance, and that's important for customer confidence, as well as from a regulatory perspective, as cyber disclosures are now mandated by the SEC. So weaker controls, poor incident responses, and communication protocols can actually bring negative attention to the company and serve to thwart all the good work that was done during the IPO and hurt the stock price. So really, it's a customer confidence and brand protection issue, and IT and security are at the heart of that. And then HR and compensation teams. I think these are some unheralded areas, but they definitely work with the board and management to design an IPO-ready equity compensation plan. They can set strategy to avoid cheap stock issues in the registration process, determining when to transition from options to RSUs, usually happens before IPO, and whether and how to stand up an ESPP, which usually happens after. All those are key considerations that HR and comp team, and as well as legal, kind of work to develop that strategy. Couple of unsung heroes I wanted to highlight in a little more detail, just based on personal experience. So I've seen internal counsel play a valuable role. I think sometimes IPOs come together. There's a lot of reliance on outside counsel, given their experience and the number of repetitions they've had at the specific task of taking a company public. And for sure, external counsel is going to keep you on the right track. But I guess don't overlook the role of an internal legal champion. They can act as a sort of like interstitial glue that binds several company functions and external advisors so that they work harmoniously. They work hand in hand with external counsel first and foremost, cascading their messaging and implementing the recommendations through the company across functions. Play a role in litigation and risk management, and evaluate what must be disclosed. I would say it's not always clear to accountants how to interpret the requirements in ASC 450 without sort of a legal decoder ring. Having someone who knows how to tell that story and work within the flexibility of the guidance to make sure you're not disclosing unnecessary items that sort of expose you is really important. They can help you get a start on sort of contract audits to identify material agreements that require disclosures, as well as making sure these contracts don't have any terms that mess with your revenue recognition or have other adverse impacts. As I mentioned, they are usually well-versed in equity comp and compliance matters, and they just have a vast knowledge when they review that document. They help coordinate the responses to the SEC, and they really can connect the different sections of the document when you talk about the business overview and the risk factors with the MD&A and the executive comp, and also making sure that the auditors don't go crazy over engineering the parts of the document that they're not necessarily responsible for. And I actually have a personal story. It's a little humbling, but I was definitely put in my place. So one of the it wasn't even the general counsel actually at one of my clients. It was an SEC counsel, and so the main thing I observed is that these individuals, they understand the company culture and the preferences and the stances of management, and they can advocate for management when interacting with external advisors. So, the company brought in a new SEC counsel to support the GC. In my first interaction with her, I was like, what is wrong with this lady? She is battling us at every turn. Like, she literally has it out for me. And I always remember, like, auditors and lawyers don't mix. And I can't remember what the exact issues were. They kind of blur into oblivion. But one instance probably had something to do with aligning risk factor discussions with financial statement policy disclosures around revenue. And we as the auditors wanted more alignment and consistency, whereas the company preferred something more general and boilerplate. At any rate, this woman was adamant and steadfast that our suggestion wasn't necessary and wouldn't trigger an SEC comment. And she pushed back super hard. We conceded, stayed in our lane, making sure the financial statements disclosures were appropriate and they followed our opinion. And she ended up being right in this instance and most others, because she had her finger on the pulse of what management wanted and a good understanding of the rules and regulatory environment. So it's that synthesis of skill sets that really, shone through here. Obviously, those minor tensions and struggles that we had during the IPO process, they laid a really strong working relationship in the company's post-IPO phase. And this is a person that I still keep in touch with, and we're good friends, and I would love to work with her in any context. So, forged by fire. Um, Anyway, over-reliance on external counsel is not sustainable, and I think having that internal advocate is something that's really important. And just to quickly touch on another sort of related unsung hero is investor relations. It's a critical but underappreciated function. I think, when you talk about bankers and finance teams focusing on pricing and structuring a deal, IR is really responsible for shaping that company story, building confidence in investors and managing expectations before, during, and after the process. They can be sort of a trail guide for the CFO and CEO as they sort of navigate the post-IPO journey, continuing that story and that thread that they told during the IPO process, and making sure that messaging is clear, they're hitting their targets, beating and raising all the things that you really want to do post-IPO to maximize shareholder value.
Awesome. We'll walk through a little bit of the sort of who's who in the room. One core pillar, second core pillar we're going to focus on is compressing the close timeline. That is something near and dear to this company's heart as a tool that really helps folks in the month-end close. So fittingly, Parker, we'll pass it over to you to talk through some of the lessons that you've learned working with some of our public companies and pre-IPO companies on the platform.
Awesome. Yeah, we will keep this brief, but I think it will kind of come unsurprising to no one that, yeah, we care a lot about this topic and we see a lot of things now. Our customer base spans many public companies today, and also, many sort of private companies gearing up for IPOs and thinking critically around their processes. Not coming from this background, it's been really eye-opening to sort of see what those differences look like, how they approach different problems, different constraints, and think about sort of the challenges and help us hopefully build a product that meets needs of companies at different stages. So some of the sort of key differences, you really just get into the rigor of these various processes and just the amount of sort of additional work that gets created as that rigor gets higher, right? This sort of is a just sort of natural maturity cycle, right? That as the companies get larger, they get closer to IPOing and then post that big event. Companies are both trying to compress the close timeline down. They're trying to hit really hard, really strict deadlines of when are they going to turn around financials. But the work multiplies, oftentimes almost by an order of magnitude when it comes to just the level of granularity and detail and accounts required. So, it becomes a hard requirement around reconciling a full balance sheet. We see the sort of flux analysis process oftentimes take on a lot of rigor, where you see companies maybe are doing a budget versus actual or an income statement comparison. Now we're starting to run, 4, 5, 10, 20, 50 different cuts of comparative financials, whether it's, year to date, prior year to date, current quarter to date, prior quarter to date, all these sort of different pieces. And so, the complexity balloons, as the sort of timeline compresses, which obviously leads to, sort of challenges and stress oftentimes amongst the internal team. So some very quick, just sort of themes that we see. One, everything always comes back to a question of it's like, how can you do more before the close starts? How do you bring more into real time into the current period? How do you develop processes and controls and workflows that are enabling you to catch errors and issues before we get to the period end? That sort of first week of the close process, those first 5 business days are the most important when it comes to maximizing the utility of them. And so anything you can do to flag anomalies, detect issues, whether that's, related to the financial presentation, also can be related to, the operational requirements of a business. What are the things that your internal stakeholders need, in terms of metadata, department tagging, allocations, the things that are going to really help move the business forward. Teams can and continue to sort of adopt better hygiene processes and rigor around, that sort of coding and flagging before the period even ends. Two, one of the places we have seen a big use of AI has been in leveraging LLMs to start drafting variance explanations. It's been pretty cool internally to even just see the change now from some of the latest reasoning models that we have started to roll out and have rolled out across some customers now. This is somewhere where teams can and will continue to get a lot of leverage. One thing that AI is very good at is taking a high volume of underlying data and synthesizing it, and providing and highlighting discrepancies and the kind of key drivers. So we see companies, both increasing the volume of explanations, volume of work, but also consistently reducing the timelines that those take, thanks to, the sort of improving infrastructure that they can operate on. Last, it's really important to identify where can we go automate further, where can we get new systems, where are there places where we can go drive, manual work out of the process. At the end of the day, our hopes is that folks can close in a day, or be consistently closed throughout the period. And so the companies that, oftentimes really impress us are the ones that, institutionalize a perspective that not only are they going to close the books every month, but they're going to think critically and rigorously around where are the opportunities to improve for the next one, and that sort of posturing of continuous improvement and always looking for and culturally sort of setting the expectations that, we're going to be looking for the opportunities to automate to pull things forward. It doesn't have to happen all overnight. The goal here is not that, people throw out their processes and, blank slate things, but that, if they make incremental improvements all the time, that those will add up and lead to significant improvements.
Awesome. Well, with those tips on general financial close practices, leads really well into the sort of output of all of that, which is financial reporting and getting ready in this capacity. So as Chris and I were sort of prepping for this, a lot of this is pretty 101. And I think a lot of folks on the call understand some of the reporting requirements. And so going to briefly touch on maybe some of the less obvious parts here and where it might be helpful for accounting teams to dive in. Oh, Chris, you were on mute. Had to happen once during the webinar, so check.
I was the sacrificial lamb there. No, that was all pre-planned. So yeah, no, I think the points here are as Tierney said, they are somewhat obvious. I think timing of this is really important. You don't want to be doing any of this prep during the IPO process. This is all stuff that needs to happen beforehand. I think something that, is oft overlooked. Sure, everyone's focusing on their technical accounting position, making sure auditors have buy-in to all their policies, that their revenue recognition and expense categorizations, compliance effort is all buttoned up before they even start. I would just say, kind of tying back to the comments on flux analyses, these are the backbone of your future MD&A commentary. So, having something that's robust there allows you a population that can provide further insight as you go through that process. Also, the SEC has been commenting on having companies add more quality to their explanations to really quantify the amounts and movement attributable to specific statements they are making in their MD&A. The other effort that people don't often think about, and it touches back to Parker's comments on sort of continuous improvement, is before you enter this, you have to quarterize your financial statements and make sure you have proper cutoff. And those are exercises that take time, but those are what are going to support MD&A and the tabular disclosures that go into your filing and allow you to compare quarterly periods that aren't in your filing to quarterly periods that are in your filing. So if you think about what actually goes and you perform quarterly reviews over versus what you'll be comparing to, I think that's that's an area that sometimes goes overlooked, and teams have to go back and sort of identify why things change from the first period to the previous period. In terms of financial disclosures and SEC filings, kind of thinking about how disclosures will map throughout the document is really important. One of the things that comes up often in the comment letter process and can just lead to sort of unexpected delays and gyrations during the process is thinking about, okay, does your business description leave some sort of thread hanging that shows a gap or a possible issue in your revenue policy disclosure or other accounting policy disclosures? And so making sure that you are connecting the statements that you're making throughout the document with the ones that you're making in your financial statements is a very important thing to consider ahead of time. And there are different readers and different groups that often take responsibility for those sections of the document. And so those groups have different perspectives. You've got someone who's trying to sort of help market the business and tell a story in the business section versus, a financial section that is much more objective, cut and dried, and may leave out some key details that happen to get filled in by the business section. And that's where the SEC can say, well, tell us about this one product or offering that doesn't seem to come through. How material is it, right? And so kind of putting your reviewer hat on and saying, where do I not want to get asked a question, and how can I word things so that it avoids that back and forth process that can delay my timing.
I love the where can I proactively avoid being asked the questions I don't want to be asked. Love that. All right, moving on a little bit into some of the forecasting, valuation, and investor readiness pieces.
Yeah, I'll just say as you guys think about storytelling, and this is something that CFO, CEO, investor relations will work on. One of the things that comes up are what are your key metrics? What are the things you're going to talk about on calls versus what are the things you're going to put in earnings releases versus what are the things that you're going to put in your financial statements, those non-GAAP measures, et cetera. And I guess choosing those appropriate metrics to tell your story is critical. And the SEC has issued updated CNDIs that can keep you out, or I'm sorry, that sort of relate to non-GAAP financial measures. And these are essentially updates to codify and memorialize sort of existing staff views that previously only existed through public statements or comment letters. And so it's essentially serving as a roadmap on areas that they're going to scrutinize going forward. I would say it's providing further guidance on the non-GAAP measures that are considered misleading. It includes guidance on operating expenses that are considered normal and recurring. So these are all kind of like red flags and buzzwords you want to be very careful about as you put them in your document. Labeling of non-GAAP measures and adjustments, reconciliation to the most comparable GAAP measure and giving it, the prominence or lack of prominence that it deserves, and then measures that represent tailored accounting principles are all areas that you can misstep. And this is really borne out in comment letter trends, with non-GAAP measures actually being the number one comment area. Some people think it's business combinations or revenue recognition or segments. Those things are still there, but have sort of moved down the list over the last couple of years as the SEC has really focused on some of the investor-facing metrics as opposed to financial ones. Yeah, kind of another touch point here just on the disaggregated income statement requirement. This is sort of the newest pending guidance from the regulators. And it really talks about how you're going to disaggregate income statement expense line items. It's a bit far off in the horizon given the 2027 fiscal effective period, but just sort of want to call that out because companies are starting to think about this now so that they have the consistency in their disclosures and can retrospectively adopt. So even though, it's applicable for fiscal years beginning after December 15, 2026, you don't want to be introducing new presentations and expense line items in that period without having something in the comparable periods to reference to. So a lot of companies are thinking about this right now. Last call out here, the comfort letter process, a little bit of a homer perspective from an auditor's viewpoint, but I think it's often overlooked. When you think about what the comfort letter is, essentially, bankers counsel will go through and circle up your filing with key numbers. And there's really no issues with things that are within the financial statements or tied to the financial statements because that's already covered by an auditor's opinion and often covered by your controls. What you really want to think about is those less straightforward figures that might get circled that the auditor will be required to provide comfort on. If they decide that they can provide a level of comfort, they're going to need support from the company. So they're numbers that you really need to know where they come from, how they interrelate with your internal controls, and sort of are they numbers that come from your books and records? Are they derived from your books and records? Because that will enable the auditors to do their work and provide the level of comfort that the bankers expect. And so as an accounting team, sort of knowing where those numbers come from, looking at that support, knowing how it was prepared and the controls that relate to it, and building that into your close processes as you kind of approach your IPO, will help you kind of get through this process very smoothly.
All right, transitioning into a very related topic, all about controls. And I believe we had a couple of potential questions in the chat too. If we want to briefly look at those and see if any of those maybe we want to touch on ahead of the next section. We got a question from Winston that Chris probably is right for you to handle. Does the accounting team typically own the non-GAAP metrics and disclosures, or is that more of FP&A?
I think it's a beautiful harmony of the two. It depends on the sources of information that come from them. I think it's really important that companies have controls around these to make sure that the information that you're providing in your non-GAAP measures is just as controlled as those relating to your GAAP measures. So I don't think that there's a one size fits all. It would sort of depend on the measure. A lot of them are very easy, right? When you take income statement items and then adjust them for one or two basic things like stock-based compensation, for example, or intangible amortization. I think those are very straightforward and can be owned by the accounting team. There's other measures that are a little bit more complex. Billings, for example, calculated billings. When I think about dollar retention numbers and looking at cohorts of customers and how their dollars kind of flow through period over period. I've seen FP&A take a lot of the mantle on that, but I would emphasize it's really a coordinated effort. The source of truth, should be a well-controlled system, and so I think it's the CFO organization as a whole, regardless of whether FP&A is more familiar with hands-on keyboard in that system or not.
Awesome. Entering into our controls SOX component, we actually have a question on this one as well that I think, Chris, you're already planning on answering, but how early should you start SOX? Any thinking on when is too early, when is the right time?
Yeah, I think we might have had something this in a later section, but it's great to bring up now. You'd expect an auditor to say it's never too early, but I think there is a too early. If it's far off, you don't want to slow down the company by preparing documentation that is in excess of the company's requirements. But at some point, you will start to develop a maturity, and maybe that means mapping controls that you perform to close tasks, and thinking about those controls and how they overlay. Maybe it's developing a risk and control matrix and identifying what your key control activities are and how, assessing how rigorous your documentation is to evidence those controls. I think it's a continuum that you can start as early as you want. But in terms of saying, well, my controls can be tested and relied upon for a financial statement audit, that's something you definitely don't want to put into place too early, but want to have a nice, smooth glide path. So that if you think about 2 years prior to an IPO, you probably have already mapped what your key processes are to your key controls. That mapping is done and people are performing them on a routine basis. As you move from year 2 to negative year 1, sort of the year that you are starting your IPO process, we'll call that negative 1, you want to actually be documenting those controls, doing them on a very timely basis, knowing where they fit within your close process, which ones need to be performed by the time that we finish our close, what levels of evidence you want at that point, and then which ones can be documented a bit later, right? You can't do it all in a 10-day process and then, be ready. I think you need to sort of risk rate your controls and when you perform them against that financial statement risk. And I would say that first year when you're a public company, you want to be ready to go through a dry run of testing those controls through the external auditor. That would also support management's initial assertion in that first year. There's no 404(b) requirement typically, but there is management's assertion, which is everything but testing the controls and having an auditor issue an opinion. So doing that dry run then and saying, oh, here's your gaps in evidence, here's what we need, here's where the bar is, so that when we go test it for 404(b) in sort of year +1 from IPO or year +2 from IPO, I'm sorry, there's not going to be any hiccups. You can minimize remediation, and get to that clean opinion. And ultimately, you want to have the auditors actually relying on your controls to reduce their overall audit effort. I mean, that's nirvana. So.
All right. Well, we do have 45 minutes, so I'm going to keep moving ahead. I know some other folks have questions in the chat, and we will definitely address those at the Q&A session at the end. But Chris, a point that you had mentioned was that material weaknesses are top of mind. That is not the end of the road. Keeps going, and there's sort of other control deficiencies to keep monitoring. Anything to touch on here, or do you think pretty well covered by the answer to that initial question?
Yeah, no, I would just say, not all deficiencies are created equal. Companies tend to, get really excited whenever an auditor finds a deficiency. I think that there's always an assessment process to figure out how material is that, right? Is it a control deficiency? Is it a significant deficiency? Is it a material weakness? And then, going through that assessment process, figuring out remediation, when can you remediate by, and sort of performing those activities and then retesting. Those types of things can slow you down and prevent scaling. And so I would just say, as early as you can, don't just be satisfied with having no material weaknesses. Really focus on minimizing any areas or exceptions that can come up, because that's what's going to make a team that's probably already exhausted from an IPO process, when they launch into that controls audit, they're not going to want to spend time chasing down deficiencies. They're going to want to be operating like a well-oiled machine, and just fly right through that initial audit.
All right, hopping into some of the contours of what those controls look like. I think probably covered a lot of the core pillars on this. So Chris, do you just want to touch on high level? We say controls when we're referencing what folks need to have, some of the core, the list that you think about when it comes to mind of what needs to be in place ahead of an IPO.
Yeah, absolutely. I think there's several buckets. They're listed here on the slide. You want to have a combination of all types of controls. I think there's like fundamental and structural things that support the control environment, segregation of duties, and sort of automated or predefined approval workflows to make sure that transactions are properly authorized, discounts and practices are consistently enforced. Those can be business and financial level controls. And then you have your motherhood and apple pie of recon controls, and doing those reconciliations on a timely basis with consistent approach across all your relevant accounts. Variance analysis. So variance analysis, again, is a backbone of management review controls. Oftentimes you're looking at trends and trying to define precision levels and thresholds, and really getting granular to getting into the details. I think those types of controls have a more pervasive effect on the financial statements and can develop into a more efficient posture because they can cut across processes, right? If you've got a good financial statement flux, it can be a catch-all for a lot of other deficiencies that could come up at the transaction level. And so you can always point to, hey, we've got this great variance analysis. It's performed at a precision level. It's well documented. And I can point downstream and say, yeah, there might have been an error in processing this transaction, but if there was an accumulation, the low variance and the high rigor with which I perform my management review controls would detect it, and therefore it cannot be a material weakness. And so that's like the backstop that you want to have. And then monitoring controls, just making sure that you have processes in place to make sure that your controls are consistently executed, timeliness of reconciliations, things like that.
And last but not least, last core pillar here is systems upgrade. I think, again, probably something that's already top of mind. While there have been a couple examples of companies going public on QuickBooks, probably not the game plan of anyone on our call today. So with that, Chris, you had mentioned that there are some non-intuitive, maybe less 101 elements of getting that tech stack ready with gating tech items.
Yeah, I think couple of the companies I worked with didn't even entertain the idea of an IPO until they modernized their sort of integration between their CRM and their ERP. And so embarked on a process to say, okay, what information do we need in our CRM at the quote level, and how will that enable consistency and rigor within the information that gets into our ERP? And so those are projects that can take several months at a time, and are expensive and require a lot of effort. Doing those things during or after an IPO is a non-starter, I would say. And similarly, I think there's other sort of satellite technology that you want to have in place that can really influence some of your other disclosures, your FP&A tools, where you get information for a lot of your other disclosures and forecasts, being able to project numbers to the street. I think having a good posture in the FP&A area and the software you're using there can really set you up for success as well.
All right, so went through our core pillars. To round this out, a couple of quick tips that we'll hit on, and then if I have time, we'll jump into some of our Q&A. First tip here, and in general principle that I think has probably come across many different points here, is historical financials don't go away. Anything to add here, Chris, beyond the reminder to all teams?
Yeah, I think and we might have a slide on this a bit later, but the 2 to 3 years, it's like, well, is it 2 or is it 3 years, right? And so I think, just eyes wide open, right? There's the Jobs Act allows you to sort of have a more minimal financial statement requirement when you do your initial registration, and then add that third year as you move through the process. I think oftentimes that third year becomes very important from a storytelling perspective by the teams that are marketing this deal to increase your valuation. And so I guess not to have unrealistic expectations as a finance department that we're going in to fully avail ourselves of the 2-year requirement, and then all of a sudden you're getting asked, as you start your initial, kickoff of the process, hey, we want to include this third year. And now you're scrambling to add another period. And that period needs to be audited. And maybe that period was a bit further away from a controls posture than you are in those most recent 2 years. And so it just introduces a lot of complexity and a lot of uncertainty. And so really trying to be clear upfront whether that 2-year requirement or 3-year requirement is going to be needed is a really important thing, because you don't want to have to go back, dot your I's and cross your T's when you're doing that third year audit.
Last component as we get into the post-IPO world is you're then jumping into the deep end of public accounting. So Chris would love to hear, as teams think about IPO readiness, what they need to be ready after that, where you've seen sort of teams come up short or struggle with getting ready for the scrutiny involved in public accounting.
Yeah, I would say, there's a lot of things that happen as the business continues to scale. We already kind of covered the, hitting your timing correctly as a public company can afford you sort of the maximum window possible to comply. So if you think about how we talked about having your controls posture and doing those dress rehearsals, if you're able to sort of structure your IPO process such that you are ringing the bell sort of in the first half of a fiscal period, that maximizes the window for compliance. Ringing the bell in November or December and then launching straight into your first 10K means that you are going to be subject to an audit of internal controls within the first 13 or 14 months of being a public company. And so really everything needs to be super dialed in. And a lot of times companies who do go public later in that window is because they've been waiting for a long time and are ready and sort of have been operating as a public company, and so can push that button quickly. Others who need a bit more time and have been doing it gradually can time their IPO for sort of the first part of the year, which gives you, a year and a half to almost 2 years in some cases of being able to comply with all the requirements of a public company.
All right, we talked a little bit about common letter, running short on time. So I think last thing to touch on here is impact on the team. And generally, this is a taxing process, one that a lot of times accountants leave immediately post-IPO. So Chris, any notes on how to think about the impact on the accounting team overall, how to sort of prevent accountants fleeing in the post-IPO process, if that's even possible?
I think it's a reality you have to be prepared to deal with. Like all championship teams, at some point they disband. The Beatles had to break up. Like it just happens, right? The fame and fortune that comes with an IPO. No, it's you know, there's a lot of factors that you need to continuity plan for. People will leave, people will be tired and exhausted. You need to do everything that you can during the process to keep your team focused and engaged. Structuring IPO activities outside the month-end close, if you can keep your team fresh and allow you to hit key deadlines and milestones. Um, so, avoiding aligning likely SEC comment response windows with your sort of key players in the close process is a sort of a hack that you want to do if you can, sort of to keep yourself on that timeline. There's usually a 30-day window for your draft registration statement where the SEC will provide comments, and then you'll have like 10 business days or 2 weeks after that. So if you can get those kind of windows lined up so that you're doing your close in the first couple weeks of the month, and then you're sort of all hands on deck responding to SEC comments in the second half of the month, and then keep that cadence kind of rolling throughout your process. That can build stamina and just overall keep yourself a little bit sane.
All right. We'll got through for the most part the end of our deck here. General comments coming through around how do you keep the lights on that Chris already touched on. So we'll launch into, I know we had 45 minutes here and we went all the way straight to the end. Hopefully jam-packed session with some tips, some takeaways. Chris and Parker will stick around for a couple more minutes to answer a couple of questions if folks have them to pop into the Q&A. And then we'll wrap it up. So with that, let's go into some of the questions that have been asked. So we had a couple in the side here that we had one from Nikita. Can you share some experiences on how to handle manual adjustments and reclasses during the close period? These are inherently difficult to automate, but also very time consuming to deal with during month end. Probably a question either for Parker or Chris, given the proximity of the close. Either of y'all want to take a stab at how to make that process easier as you're compressing that close timeline.
Yeah, no, I can, and Parker, please add on. So I have booked very few journal entries in my life, actually. I may have accidentally booked some journal entries here at Numeric. Someone should go check those.
We are checking those. Yeah.
Yeah, thank you, please. So yes, I think, the idea is to structure your process so that you're not doing a ton of manual adjustments and reclasses during the close process, right? What you want to do is cleanse that data ahead of time, making sure that you're properly categorizing transactions, recording to the right department, that you are reaching out to vendors for accruals on a timely basis so that what's in your AP versus what's not in your AP, moving things into the sort of negative close days period. So that you can kind of narrow that population, right? It's like, okay, well, what are the entries that we really have to focus on that are traditionally manual, right? Tax process is usually the caboose that brings them up. If you can limit things to, tax and maybe a few like allocation entries, I think you're doing pretty well. Allocations kind of happen at the end as well, once all the other entries are recorded and you can kind of move them around. And so I would say like, you will have manual adjustments. I would structure your process so that those are, the one or two things you're doing at the end. And, if they're less automatable, at least they're just taking, that last half day of your close process.
Parker, anything you'd add there?
I would just quickly jump in. I think the goal should always be sort of push the work up the funnel into sort of how's the data entering the system, where can we be more structured, and where can we go make improvements such that the downstream work, is easier. And so there are going to be places, right, where there are just things that have to happen at the period close. But I do think there's a lot of opportunity and a lot of in many ways like a good punch list, which is like you look at those things that are slowing things down, that are manual, that are time consuming, and those are the things to go start to put the list together and think creatively about how do you go emphasize solving those. And again, I don't think the goal should be like you do all of them next month and for the February close, but you start to put a list together. Okay, what do we want to do in February and March and April, and try and take them one at a time.
Awesome. We had a question from Paul around what does an IPO-ready accounting and finance org usually look like? And to that, I will initially say we do have an IPO readiness guide that is a deep dive into many of these questions, including that one that we'll follow up with after the webinar. And so we'll let Chris and or Parker touch on this, and then also we'll point to that resource as something that we'll follow up with that I think will have additional intel on that. So Chris, any insights into what that org typically looks like from the window you've had into it during IPO process you've been a part of?
Yeah, people always want to ask this question, are always trying to benchmark, what do I need to have in place? Who should I hire? I think it's a pretty big source of stress, is just getting the right people, systems, processes in place. I think, it's a very broad question when you're talking about an accounting organization versus a broader organization. But you need, I would say, like a domain expert, functional expert in each area, so that you don't have gaps. And probably within the finance organization, that means you've got a domain expert in revenue. You've got a domain expert over, general operational accounting. You've got someone that's looking over payroll if you want to split that out, depending on the complexities there. You've got someone looking at stock-based compensation, and sometimes that's co-sourced with legal. And then like, your technical accounting and SEC reporting group. How big does that need to be? Do I just need one person who's drafting stuff with an outsourced function that's helping them? Or do I need a few technical accountants reporting within the team? And can they fill their time within the organization when they're not doing SEC reporting with other operational roles? And that's maybe a good way to incubate talent within your organization. And that's where I've seen leading companies like Google and Apple, like you've got all-stars that come in into a technical accounting area and then move into operational roles within the business.
Very related, that last point on do I need to outsource this is something I can do internally. I think last question we'll touch on is Jen's question, would you highly suggest to hire external technical accounting teams to assist in the IPO process? So very related to how we structure that org. Any insight into when it makes sense to tap an external party on the shoulder for help?
What I have seen is that external help is needed. And so you need a trusted advisor who can help you respond to, auditor comments as you're drafting your financial statements, help you put together, more complex disclosure areas. I think having a few additional resources to supplement your team can give you the flexibility to respond in a time of need. And so engaging those types of firms and those types of resources before you need them to build that relationship, that trust, those repetitions is really important. And I've seen in the IPOs that I've worked with, there's always that trusted third-party partner, and they use them to a greater or lesser extent, just depending on what else is going on with the organization, right? If you're doing an acquisition, you may have all hands on deck internally, and you need to outsource your external reporting, and that can be picked up pretty easily and transitioned. And then you can do a review process over the top of that. So I think it's good to partner with external firms to make sure that you can address any capacity issues that can arise.
All right. And with that, that is a wrap. Thank you to everyone who attended, who thoughtfully asked questions, posted in the chat. It is always better when we have great questions coming in. And so appreciate your attendance. We will follow up with a couple of resources put together from our team, including some additional insights from Chris. We have an IPO readiness guide and IPO readiness checklist that hopefully are helpful as you're thinking about this process for your team, and are always, welcome from the folks on this call to also have one-on-one conversations. So if that's helpful, feel free to respond to the email. We can get those set up. So with that, I will say thank you also to Chris and Parker for showing up, for relaying some of the insights that you've learned, and hope everyone has a wonderful rest of their day.
Thank you, Tierney, and thank you, everyone.
Thank you all.
All right. Thanks, folks. See ya.
Bye.
Bye.